The NASDAQ's the underperformer. Well, the S&P is underperforming a little bit too, but in many respects that's related in some part to tech stocks.
The regulatory relief gives you the best opportunity to extend that broadening out. But the last thing I'll say on this is the chase for performance. Everyone keeps talking about it. Chase, if you haven't caught the market by now, you're not catching it.
You know what this is now? This is the chase for outperformance. How much can you outperform the market now if you do have that run that people are talking about from election day to inauguration day? So, Weiss, I don't remember where I read, but, there's a good article today on Bessent, what his beliefs seem to be, a three arrows approach, much like Shinzo Abe over in Japan. You spur higher economic growth through lower taxes and deregulation. You get the growth, and then the growth lowers the deficit, right? You can pay down the deficit by higher growth, and you increase domestic oil production as well. And you look at all three of those pillars, so to speak, and they're working in the market, as we said. Stocks up on the belief you're going to have higher growth. Rates down on the belief that you get higher growth, you lower the deficit, and then oil's down today because, well, why? You're going to increase supply domestically, so then oil falls. Is that sort of that simple for a day?
It is that simple from the top. Of course, the details are always different. Now, I used to deal with Scott fairly regularly when he was at Soros. First when he was in the U.S., and then when he was running Soros London. And he's a very thoughtful person. He's a student of economic history. He was a macro investor, still is a macro investor. So I think he's sort of got the right balance to go in and do what needs to be done now. And while he says he's going to make sure that Trump's economic policies come to light, he's also going to be able to, because he's got Trump's confidence, obviously, be able to tell him where maybe that's not the best thing to do. So I do think part of the market today is because of Scott, because Wall Street knows him, and they know him to be very thoughtful. Now, in terms of his plan, look, the market's going to keep going right now because you're seasonally in a great period for the market.
It kind of needed another catalyst to get to the next level, right? And this sort of took some uncertainty off the table, as you point out, a selection that is going to be very favorable in Wall Street's mind.
Right, and so you've got the expectations going to build up, and then I think you'll see pretty immediate action after January 20th rather, because look, they have the trifecta, the Republicans, and if one thing that there was that people appreciate about the prior Trump presidency were some of his economic policies. So just think of what it'll be when there's no more tax on Social Security, when there's no more tax on tip wages. That's all going to be going to the economy. However, they're going to have to watch the other side of the ledger, meaning inflation. And that's the one place where all this can go wrong. Between tariffs and all that, that's what you got to, but it's too early to worry about that at this point.
Okay. So, Bryn, give me your view. You got, the Dow up 6% since the election. The S&P and the NASDAQ are underperforming both the Dow and the Russell. But that's because technology hasn't done fantastically since the election. So naturally, the NASDAQ and thus the S&P are going to look a little bit worse than the Dow and the Russell. Russell, though, to Joe's point about the broadening and whether it continues, up 9%. If you're going to spur and stimulate economic growth, then that's where you look, right?
I've been really consistent, and I still think that we've chosen to express the broadening out with RSP, which is the equal weight S&P. So we're staying large cap, we're staying quality. And you see RSP today is up, over 1%. We also have a free cash flow ETF we use, that's up 1.5%. And so I don't think you just have to say S&P or no profitable Russell 2000. I think the equal weight is still going to be where you're going to get consistent flows. I think also to Steve's point, longer term about inflation and what happens with inflation next year, as soon as we get any kind of hiccup, if CPI or any of the PCE starts even ticking higher, you're going to immediately see that with algorithmic trading down Russell 2000. And so I think we want to continue to stay large cap, but RSP. And I think it's important to understand with RSP, although it's equal by security, it's not equal by sector. The top two sectors are financials and industrials. And so you really get very different exposure from a sector perspective than the S&P.